Check the markets. We're not at the highs of the session, but nonetheless, we obviously have pretty big gains across the board. This was always the risk, wasn't it? That just like Liberation Day, you get all bearish and you have a president whose most critical scorecard is right up there on the board here at the New York Stock Exchange that shows the major averages in the stock market. And a headline like the one we got this morning and the comments that we got from him directly this morning have caused quite a rally.
Well, last year, Scott, the Trump put, if you would, was in the bond market. The Trump put probably was in the oil market in 2026. And I think that's ultimately what we're witnessing right now. We still do not have enough information in an environment where you properly describe it as being binary to make a determination if ultimately this is the moment where we just significantly move higher from here. I do think today is a very important day from two aspects. Number one, first of all, the systematic trend-following funds utilize three closes below the 200-day moving average. Today would be the third day closing below that critical 200-day moving average at 66 and a quarter. Do with that information what you wish. It doesn't mean you're going to see significant selling on the close. It just means the overall bias will flip the same way it did last spring, which was the wrong move, and the same way that it did in April of 2022, which was the right move, because following that, you had 149 days below it and 20% down. The other element to all this that I think is important, I think
what we can say reasonably, the floor has risen up a little bit. And I don't know if that's risen from 60 to 65 to 70 or 75, but I think the floor has come up a little bit.
And you have fundamentals or risk premium?
I think both. I think fundamentals are going to be that all the inventory is going to be drawn as a result of how long this the war lasts, the floating inventory and the onshore. So we'll have to replenish inventories on the back end of this. But there has been some structural things that have happened as well. Like you said, facilities that have been hurt and not the ability to produce oil, generate the product. So some of that's going to take some time to rebuild. So the whole system has to recalibrate. That is going to take some time, which I think raises the floor on the bottom side of prices. You can argue $5 or $10 or what that does. And the real question is, what's the trajectory beyond that? And we've been pretty constructive even before this engagement of this war in the Middle East. I think it gives us more confidence that the price is probably going to be higher 3, 4, 5 years from now.
Okay. You've got a huge refining business getting bigger with the Marathon deal. Right now, at this price point for retail gasoline, are you seeing any demand destruction in the American economy?
Yeah, so we're an upstream company only. We're no longer integrated, but we are seeing a little bit of changing behavior in the consumer. So,
like what?
Well, I think the real key is as we come into the summer months and we see what happens in the gasoline price, the reformulation that the president announced, try to get rid of the summer blend and try to help that is going to help. But yeah, we're all watching that pretty closely to kind of see what happens is there demand destruction, not only in the product space, but also in the oil space.
WTI, there it is. It's back, though, at 90. So keep your eye on that and thus keep your eye on the stock market. But that's the relationship that matters most of all. As everybody seems to know, oil down, stocks up, pretty simple. How about another one? Stocks down, Trump put.
Yes.
Pretty simple, because Citi today says the so-called Trump put still prevails.
Yeah, I would agree with that. And I think that where we found that Trump put was specifically in the oil market itself. There's optimism certainly built into the tape over the last 48 hours.
Cautious
for sure.
Optimism, maybe,
well,
right?
I think what you're looking for is the confidence that you can find the evidence that you're validating that optimism with obviously some form of a resolution. So in the interim, I think you're going to see volumes begin to thin out. We saw that yesterday. We are also approaching the end of the quarter. Again, that might lead to a little bit of volumes thinning out. So I think you're looking for some tactical setups. I think I found one yesterday in gold. I really think right now, while you're sitting in this waiting period to confirm the optimism, that's really your best weapon.
Jenny, you can get an idea that firms are trying to game this out a little bit. Think they can start to maybe look beyond it. JP Morgan's trading desk says they're closing their tactically bearish call and they're moving to neutral. Now, it's just a move to neutral. However, it does signify what I think is fair to say, this cautious optimism that there's going to be some level of resolution in the nearer term.
We have to go a quarter, 2 quarters, 3 quarters without much to show for all this volatility. Truthfully, it all comes out in the wash. It's not the end of the world. If you are looking to do something that is a little bit more proactive, what you're probably doing is sticking to the stocks that are working at the moment. And those include energy, oil stocks. Valero still looks great, all of the refiners. But again, that's a fairly narrow lane. Most stocks are just chopping.
Hard to really have some high level of conviction anywhere as long as we remain in this sort of murky, foggy area, right, Malcolm?
Yes, but I think 4 weeks ago, when this whole thing first started, we could make the case that it's probably going to be short-lived. It's probably going to be a blip on this quarter's earnings reports. It's probably going to be a thing where it's a temporary shock to the system. I think as we go into now, earnings season rolls over into next week. We have CEOs presumably telling us that they can't quite forecast what their transportation costs are going to look like, what their energy costs are going to look like. The guidance that they give is going to be less sure than it would have been had this conflict been over before March was over. And so I think that we have to consider that negative sentiment and the weight that it could have on investors coming into earnings.
I think it's a great point, right? The numbers are still expected to be good.
Yep.
Earnings expectations and estimates, even moving forward for the quarters ahead, are still good. Malcolm raises a good question, though. What happens if the narrative starts to deteriorate? How much say will that have into how the market trades?
Yeah, so I think CEOs are going to be so.
Oil prices are still moving higher. Yields have entered the building, and Fed talk is more hawkish. Market expectations of Fed activity has moved more hawkish. So what do you do with all of that? Because I would submit that right now, oil and yields have way more sway over this market than the president backing off a threat like it's a tariff decision, because this isn't that. Barclays addresses that as well today. They say, quote, headline fatigue is starting to undermine the Trump put efficacy. Trump's apparent willingness to de-escalate the conflict has kept equity markets afloat so far. The risk is that constant flip-flopping and headline fatigue is starting to seriously undermine the efficacy of the Trump put. Now, I don't think anybody believes that the so-called Trump put is dead. I still believe that they think it's alive and well, and for good reason. But this isn't tariffs, okay? And it's very easy to make, according to Goldman's Tony Pasquarello, who published just before we came on the air today, you could make a very tactical bull and you could make a tactical bear case in the same way. It's not like Steph is wrong, because you can make a tactical bull case, but you can just as easily, for the first time in a while, make a real easy tactical bear case too.
And there's a lot of asymmetry on that. I think the bull case certainly can be made. There's probably less upside to the bull case. I think the bear case, if it plays out really negatively, could play out much worse. I find that what's kind of most interesting in